Churchill Capital, CCIV, has blown up over 41% over the last 2 days on rumors that they're going to be taking Lucid Motors public. How can we get a position in this high-flying SPAC? Hello, I'm Doc Severson. This is the Ready, Set, Trade of the day for Wednesday, the 13th of January. Here is the daily price chart of CCIV. I'm recording this Wednesday morning prior to the market open, so you can see that there's only been 2 days of real accumulation. Most of the time, the price has been staying around the floor of the SPAC level, which is around $10 a share. So there we go, buy the rumor, but the other half of that is sell the news. So the problem is if you actually wait until the news comes out on this thing, more than likely it's going to be retracing by that time. Buy the rumor, sell the news. So people that jump in at this price level based on rumor are likely to maybe sit there on dead capital for some time before the price comes back up to that level. Now, it's not like we're talking about a $3,100 Amazon or anything like that. This is still $14 a share, although in the pre-market, I see that this is actually starting to get closer to $15 a share already. Now, one of the alternatives to trade the stock is to go over to the warrant. So if we type in CCIV/WS, we can see that the warrants, instead of being around $14 per share for the stock, are about $4.74 per warrant. So there's certainly a lot of more bang for the buck on something like that. However, what we have is, if we go back to CCIV, we can see that there are options which are being printed as of today. So today, these will be traded for the first time. And what I'm particularly interested to see is if I can get the 1250 strike for the February cycle. So we won't know how these trade for another hour and a half when the market opens and they start to trade and they start to develop bids and offers for all of these options. Each option is its own market. So I like the 1250 strike. Let me show you how I came about that. One of the best tools for price action when we have one of these stocks ripping like this is to go into the fib retracements and run the fib retracements from the bottom of the move all the way to the top of the move, and then look for likely landing places for the price to come back to. One of these is 38.2 retracement. That's the 1350 level. The other one is 50%, which is about 1283. And then as far as 61.8%, which is just above $12 per share. So that 1250 strike sits down there in a really nice area that represents value to me. Now, the problem is the further down out of the money, I could even sell the $10 strike, maybe, if it's going for enough, and that may be the best trade to do. So this is what I'll have to do is here's the 1250 strike, here's the $10 strike, and the price is going to open up somewhere around 15 or so this morning. What I'd really like to do is get a dollar credit at the 1250 strike, because a dollar credit is going to mean that I receive $100 per contract, and then I'm going to divide that by the actual capital that I need to leverage in case I am assigned. And what we're going to find out is that that is 8%. So an 8% return is about what we're getting on these SPACs these days. You're not really going to find that type of return on the amount of capital invested pretty much anywhere else in the stock market these days. And it's due to the risk that perhaps the merger between Churchill Capital and Lucid will fall through at some point. But we can minimize our risk by minimizing the time that we're holding the position. So again, that is my goal, is to see if I can get a dollar for the 1250 strike. Don't know if it's there. And I may have to consider going further out in time to the March cycle, which again, we don't know what these are pricing. So this is kind of a complex arrangement that we have to determine. We have to look first at what strike price that we want to sell. Number one. Number two, we want to look at a minimum credit for that. And then based on what's available, we may have to go further out in time to receive that larger credit. So I'm going to be doing that first thing this morning with our live trading room in our elite service. Now, when we trade a cash secured put, what happens after that? So I receive, let's just say I get $100 for selling the 1250 strike for February. What happens from there? Well, if the price continues higher, then I do nothing. I just keep that $100, and at February expiration, my obligation is released, and I move on and do it again. I win the trade. If the price goes sideways into February expiration, I do nothing. I keep that $100. My obligation is released and February expiration, and I do it again. Even if the price comes down to something like $13 per share, same thing, same resolution. I keep the $100, nothing happens. My obligation is released as of February expiration. It's only if the price gets down to $12.50 or below by February expiration, sometime out in here, that I may have to do something. If the price does go lower, down below $12.50, then I may be assigned, which is kind of what I'm trying to do anyway. I'm trying to get paid to buy Churchill Capital on a pullback. I love to get in these EVs at a low price. And if you think about it, my actual cost basis now, instead of being $12.50 a share, is going to be $11.50 a share if I do get that $100 credit or $1 credit on the option. Again, this is a strategy called a cash secured put, and it's part of the wheel strategy that we actually offer for free as part of the 10X tribe. If you join us at elite.readyset.trade, you can get the wheel strategy class for free for being a 10X tribe member. Thanks for listening. We'll see you in the next one.